All right, let's get started with the first conversation for the day. And this is a very important concept to understand. Let's talk about risk, the nature of risk, your risk-taking capability, and your tolerance for risk. Why is it important to understand risk before you venture out to make your investment decisions? Can a test tell you with absolute certainty the level of risk that you would be comfortable taking? Those are some of the questions that we will seek answers to in the first chat today. My guest is Santosh Tiwari, who is the COO of ET Money. Thank you so much, Santosh, for taking the time. Let me start with the most basic question of all. Why is it important to understand risk tolerance, and risk-taking capability when you set out to build an investment plan?
So risk profiling is, I think, one of the most important and important ingredient to how you plan in your investments generally, Alex. It's at the heart of the planning process, I would say. If in general in planning exercises, whatever we do for in our jobs or in our lives, anything big you begin, you always look at your strengths and weaknesses. You try to understand your current position to really plan better so that you can succeed at what you're doing. And investments are no different. It's like I need to know what are my strengths as an investor. I need to know what are my weaknesses as an individual, so that I can avoid any kind of traps I might get into unknowingly. So it's like it's something where I need to understand how will I react to markets. I need to understand how will I will I be able to control any kind of greed I may have? Will I be able to kind of respect an investment plan? All these factors are extremely important before one makes a plan. And in the absence of risk profiling, what happens is I don't have a starting point as an investor. I would actually go towards buying the top performing funds and nothing else to look after. I might just buy a top performing fund or a good stock without looking at associated risks in between. And if I don't look at risks, things can surprise me in a wrong way. For example, what happened in March 2020, 2 years ago, during peak of COVID, in the wave one, people actually would have been terrified by the 40% drawdown or the correction that the people saw in the marketplace. And if you would have been a conservative investor wanting to buy actually being invested in an aggressive fund, you would have seen very difficult times for yourself. And what would have happened is you would have got out in June 2020 or July when markets actually came back to respectable levels to cut down your future losses or recover your principal. And actually, in these kind of moments, you miss out compounding. So to avoid wrong decisions, you need investment profiling. For taking the first step, you need investment profiling. And risk profiling is one of the first aspect to get it right.
I think you've hit the nail on the head to describe how important this is to understand and various aspects here. But I'm curious, can you, with 100% certainty, identify what your risk profile is? Because I'm trying to understand if there is a margin for error. We're talking about these tests that you can take that would identify what sort of buckets you would fall into.
Yeah, so the thing is accurate to a level that you can say 100% accuracy, Alex. But I think there are reasonable ways available to trying to predict or trying to estimate one's real sense of behavior that would happen. So in risk profiling, generally what has happened in the marketplace is people have tried to make it too simple to a level that it becomes useless. And at ET Money, we believe that there is a scientific way to get it done in a proper way. So what we do is we look at three aspects to get it right and do a good job on that side. One is we look at your behavioral and psychological factors which determine something called as we term as overconfidence or confidence to take decisions. Now, it tells us one thing: if you are confidently taking decisions, you would probably put enough efforts in researching it. But when there is a tinge of overconfidence to your decision-making process, you tend to make hasty decisions. And what happens is the moment your financial situation improves in life, chances are very high, if you're an overconfident person, you will take a hasty decision. And decision made in haste can get you wrong. So we look at this aspect of psychological and behavioral factors, which helps assess what kind of person you are. Second, we look at loss aversion. So typically what happens in loss aversion is people associate that somebody who has risk-taking capacity can also be actually having the kind of wherewithal to tolerate losses. It's not like that. The fact is there is something called as stated risk preference and revealed risk preference. It's like I might say that I would weather a drawdown of 10% or 20% and withstand the volatility in the marketplace when things are not going good. That's my stated preference. But when I see a 20% cut in my portfolio, I might not behave the way I stated myself. That's called revealed preference. So we look at both these aspects and try to ask you certain questions which help us understand this better. And hence, based on that, we basically find out your aversion to losses. And third aspect is financial mastery. If you are somebody who understands financial products better, chances are very high that you will not take a hasty decision. But if you don't understand them better, then you might just look at an isolated return metric might move you to make a wrong decision. So these three factors help us understand your risk profiling far better. And whatsoever we have done so far, people tell us that it's kind of discovery of their own selves, and they don't find it wrong for themselves.
Interesting that you point that out. I did take your test, and I have to point out that, by the way, there's no winner in a test like this. The higher your score does not mean that you're better than everybody else. It simply tells you where you fall in a spectrum, right? And interestingly, Santosh, the risk test that you have, you call it a personality test, right? You'd call it an investor personality assessment. You're not calling it a risk profile, because you're also talking about people's personality traits, and you measure risk in a range. Why is that?
So I answer both the questions, Alex. So when you look at the risk investor personality, so we call it as one for a reason. So what has happened so far is risk profiling has been a process of bucketing you as an investor into fixed labels, as I call them. They are conservative, moderate, aggressive, very aggressive. Now, what happens when you assign these labels? You become a conservative investor for all kind of portfolios you might want to invest in, for all kind of goals you want to invest in. The moment you say aggressive, people will start building portfolios which are high risk taking for you. Now, the fact of life is anybody who's aggressive will still be investing in a less riskier manner for his short-term goals. Somebody who's conservative may still be investing for in a slightly more aggressive way for her long-term goals. So it's like they are not written in stone kind of labels that we behave in real life, because things also change. Our salaries go up, our incomes increase, we become more stable in life, our liabilities might go down as with age. So a lot of things happen where things determine our future outlook towards things. And hence we believe there is something called as a dynamic risk range that we should be looking at, instead of giving you a static score in a form of a label. And typically sometimes people, when they've given a label, kind of a number as well, they've given a static score like 56 out of 100 or 75 out of 100. Now that doesn't cut ice in real life. So we look at the dynamic risk range, and we try to give you that archetype of conservative or moderate into a different shape and size, called as personality traits. Like, are you an explorer? Are you a strategizer? Are you a researcher? Are you an observer, a protector, a seeker, and an analyzer? So there are 8 personality types which basically govern what kind of person you are. And that is less likely to change as you go forward. So a dynamic risk range helps us plan things better. If you have a risk score of 55 to 75, for example, then the system will look at how we should plan. We should basically plan your short-term and medium-term goals towards a risk score of 55 and your long-term goals to a risk score of 75. And that helps good, because then everybody can become financially free by taking less risk for short-term goals and bigger risk for long-term goals.
I won't specifically ask you about some of the questions, though I'm very curious as to how they tell me about my personality type. Because there were 1 or 2 that had to do with my expectation of, well, I won't get into that. Let me not get into that. Let me not spoil it for anybody. But I'm curious, how do you come up with the questions?
So we worked with a team of behavioral scientists in the UK who helped us, with the understanding of this entire piece much better. We worked with them for almost a year, kind of ran a lot of tests, ran it on samples, and this test or assessment, as we call it, is actually quite self-learning. So we don't it's not going to behave in a way as it's behaving today, in a way that if India as a country over a sample size of 100 and we look at next year, if it is becoming more aggressive, then relatively your score will improve further, or rather not improve, it's the wrong word as you said, it's not improving, no score is less or good. The score might tilt towards the larger average. So we as a country might change 2 years from now. We might become more aggressive and have everybody relatively become more aggressive. Even a conservative person will become more aggressive. As we are seeing today, when markets have actually become far better, everybody who was conservative has probably become a mutual fund investor, from FD to mutual funds. Somebody who was mutual fund investor has become a stock investor. So as generations, we undergo a lot of changes. So this assessment is actually self-learning in our systems, where we will basically look at not you as isolation, but entire sample set we are looking at over a period of time.
What is the average of the tests that you've conducted so far? Is that something that you have handy?
Yeah, so we've done close to 100,000 tests so far in last 6 odd months. This has been there on the app for a while, and we have insane amount of understanding how people behave. In fact, we try to correct. This is a complimentary service available on ET Money. Anybody can take this test and try to plan their investments better. We actually nudge people in that you actually are taking more risk than a risk score. You're taking actually less risk than a risk score. And we also nudge people in terms of, your asset allocation look like it is actually made for risk score, which is not yours. So there are multiple ways we have been using this as well, and people actually been loving this. And the idea behind the entire thing is it should be fun. So far, whatever risk profiling tests, as I call them, have been available in the marketplace, they typically make it too simplistic, and I might be casual in answering them. But if you have experienced the app and the assessment yourself and done it for yourself, you would have noticed this is very engaging assessment. You actually want to answer question properly. It's very visual. It doesn't ask a lot of textual questions. It shows you something, and we see how you react to that. And when you do things in picture, people actually do a better job than actually reading a question and answering them.
Okay, get that point. My last question is, and you've kind of answered this already, so maybe just tell us a little bit about what a strategizer would mean, or maybe an explorer. What do these tags mean?
So all these personality archetypes, Alex, are actually a determinant from the three factors I talked about: the psychological factors and behavioral factors, which help us assess the overconfidence or confidence we express in decisions, the financial mastery, and the aversion to losses. So all these three things come together and decide: are you somebody who is actually a strategizer? Somebody is some mostly overconfident person. He likes to strategize a lot because he researches his moves far better. He tends to basically take things for granted over a period of time. Hence, a strategizer who is somebody with a lesser risk score may do better job than strategizer who is actually having a higher risk score and also is a strategizer. So it is practically possible that one is a strategizer and has a less risk score as well as a higher risk score as well. So they determine how you act. Like for explorer are people who actually like to take baby steps into some things and like to avoid losses in life. They explore, but they want to avoid the losses. There's an adventurer who doesn't mind taking a loss just because he wants to experience something new altogether. So all these personality traits are based on the questions that one answers on the app as well. And they help us understand what kind of communication you would react to and which is going to be beneficial for you to better your financial life.
This provides you with a base from which to build on. Thank you so much, Santosh, for taking the time. Always a pleasure speaking with you.
Thanks, Alex.